Hey, good morning, everyone. Marty Missouri here, April 13th, 2022, with a brief stock market snapshot for you. Before I get into the graphs this morning, folks, I just want to make a point here. I can tell from the very limited amount of action that these videos are getting that this doesn't really interest many of our clients. However, it's a pretty consistent small number of people who stay with these from start to finish. And I pretty much know who you are from the feedback that you've given me. So it's still worth doing it for you folks who find, for whatever reason, find interest in these quick technical snapshots. But for your clients who might have logged on just to see what this one's about, just so you know, this isn't just for fun. What you're seeing here is, we can call it a snapshot of what we do across every position that we have in our portfolio. On a weekly basis, we'll dig in and do some real detailed charting of trends, momentum and so forth for each position. Now, we are long-term investors, although we're having to be pretty active, as you've noticed, you clients, in this environment, both from an asset allocation standpoint, but also from a hedging standpoint. Where it helps us from a long-term perspective, though, is with entries, exits, that sort of thing. We seem to always have an inventory of new cash, either clients, maybe they sold a property, maybe we took on a new client that was referred to us, or so forth. And so we have to make a decision each and every day with that inventory. Do we allocate any today? Do we let it sit for a day or three or what have you? And what do the charts say about the timing? Ultimately, the money gets invested. Obviously, our core portfolio reflects how we feel about current conditions. But when we're sitting with new capital, yeah, we want to be tactical. When it comes to movement among asset classes, typically I'll see, short-term developments that might have me think differently for the next 6 months about something that we're in that we feel great about for the next 6 years. And I've talked about that with regard to commodities. We are very bullish in commodities right now for the long term going forward. But we had such a big run. Some of that was exacerbated to the upside by Russia and Ukraine. And having been in these markets virtually my entire adult life, I know that commodities can be exceedingly volatile from time to time, even in an overall bullish setup. So we have begun hedging some of that commodities exposure, knowing that a resolution in Europe, a slowing of the economy abruptly in certain areas could see commodities tumble at a time when we still want to own them. And in that event, the hedges would, of course, be very profitable if we're in them when they tumble. And of course, that would give us some ammunition with which to probably add to those long-term bullish commodities positions that we have at much lower prices. So that's the sort of thing we do. And folks, the technicals help us do that. Okay, so again, doesn't mean any of you who aren't interested in this stuff need to hang on for the rest of this. For those of you who do find value or interest in this, I'll run through just the S&P 500 again this morning. So you're looking at the 60-minute chart. And I did some work on this yesterday and actually drew this downward sloping wedge. Actually, it was the day before yesterday. And could see that on a very short-term basis, this is a pretty bullish setup, right? We have our declining wedge, which is a bullish pattern when we have positive divergences on the moving average convergence divergence, or the MACD, or the relative strength index, or the RSI. And we actually have those there. You see how we have a notably lower low on the hourly chart, but we held right there where this low was, and we actually had a higher low here. Again, this is a bullish trend. Yesterday, I really thought that we were going to break out of this to the upside because we had that pattern there, but then we fell apart toward the close, and we're about an hour or so away from the close right now, and so far, today's rally is holding up pretty nicely. So we've broken out of that wedge for the moment. And again, a swing trader or a day trader, this would have been a good pattern. Even if they took this position yesterday and held it to today, they're probably in pretty good shape. But of course, for our purposes, we're more interested in things like the 1-year daily chart. And there, we still have issues, right? So we have this range here that we rectangled, much like the range in fourth quarter 2018. we had the 50-day moving average drop below the 100-day, and now we have the market doing battle with its 50-day moving average. The close below yesterday was bearish, and so we have support here at what is this 38% retracement, moving back toward the top, retracing that, and resistance right here at the 50% retracement, plus this other resistance line that we draw on right here, plus the 200-day moving average. So while today's 1% move right now in the S&P is impressive, there's definitely some headwinds as we move up a little higher here. Closing above the 50-day moving average would be a positive. We still have a sell signal here on the MACD. The weekly chart is still struggling right in here, folks. This is a very concerning pattern, right? I showed you 30 years of history where when we break down below the 50-week moving average, test it, battle it for a few weeks, and then lose it, we tend to come down and at a minimum test the 200-week moving average. Hasn't happened yet, still doing battle. Looks like a lot of those patterns that I showed you in the past. So right now, if nothing else, this is just a very concerning look. Doesn't mean that the market won't, blow through that. Probably would take very good earnings now that earnings season has started, or good outlooks, and I think there's some issues there. And then the monthly, that 25-year monthly chart continues to look concerning. We've got a sell signal on the moving average convergence divergence. That's what that is when the white line drops below the red. And every sell signal in the last 25 years has been met with a pretty decent double-digit decline. Now, I would argue, though, that if you go back to last November at the peak, we did get a pretty good double-digit decline, and we're kind of trying to work our way out of that. So in theory, this could be all that she wrote here, but this is something that could gain momentum to the downside. I know as of yesterday, the S&P was down close to 8% on the year. That's a rough start to the year, but boy, it sure could be a lot worse given all the headwinds that the market faces right here. Fascinating, though, that bonds, the longer-term Treasury bond index is down over 16% year to date. From what I understand, that's the worst start in history. And folks who are in those traditional 60-40 portfolios are feeling more pain than that setup is supposed to deliver them. We're actually keeping a very close eye on bonds, both U.S. Treasuries and international bonds, emerging market bonds in particular right here. And we could see a scenario where we actually may take a position and get some nice yield generating positions in portfolios. If we do begin to see something waning on the inflation end, we are in that structural long-term inflation camp. We don't think 2% inflation is on the near-term horizon, frankly. So we see something higher than that. But we could see it coming off the boil a bit. We think it can draw into question the Fed's tightening posture right here. You could see a bid under bonds and those yields come off a bit, particularly in the emerging markets. And there's a lot else that goes into that thesis. So that's on our radar. You got confirmations this week that we did do some other moves out of certain asset classes into others, kind of a little more defensive posture on balance, not entirely, but on balance, I guess you would say that. So we're taking a little bit of risk off the table here. So folks, I will leave it there. Thank you, as always, for watching and listening. Be back soon. Take care. Bye-bye.